All right, welcome everybody to a presentation that I'm going to be hosting today on the topic of an entire trading strategy for life. Now, I'm sure you've probably clicked on similar videos in the past where you were promised X amount of dollars in X amount of days. This has nothing to do with that. I want only serious people to watch this video, people that actually take trading rather seriously and want to really hone in their craft. So I warn you, this is going to be a very, very extensive video. It's not going to be short. We're going to be going over definitions, statistics, markets, time frames. This is going to be quite lengthy. So if you have TikTok brain, I would please advise you click off the video now. As I said, I only want serious people to watch this video because I really took my time and effort to prepare this. As I said, it's going to be quite lengthy, and I want to make sure that this message gets across to the right people. So if you're the type of guy that's okay with being average and just doing as little as possible to carry on, then this is not for you. And I want to warn you in advance, obviously. If your attention span is rather short, then I don't want you here, okay? But if you do, then welcome. And we're going to be going over a lot of things today. So what exactly are we going to be covering in this video? Well, since I'm going to be giving you a full strategy rundown, we have to structure things in different sections, obviously. So we're going to be starting off with the definition of the setup plus some images for those of you who are a little bit more of a visual learner. So what is the setup that we're going to be trading is the first thing that I want to be answering today. Now, what is the theory behind the setup and why is it supposed to work? That's another thing that we're going to be spending a little bit of time on, because I got to make sure that your confidence is there to believe in the setup, because you may get periods where A, the setup is not working, or B, the setup is just simply not showing up. So I want to help you a little bit with that. In the sense of giving you why is it supposed to work, because there is a concrete reason that I believe makes this setup worthwhile. Not to mention, I obviously also have the statistics to prove that it indeed works. The time frames that we're going to be using, just to give you a little bit of a spoiler here, we're going to be using 2 time frames and 2 time frames only. I believe that is more than enough, and how I have been testing this pattern. So 2 time frames is going to be what we're going to be aiming for today. Now, the context of the pattern, and this is something that's very crucial, because although the pattern is objectively defined and there's no room for subjectivity, there's still context that we need to consider. I would say, if I had to give a percentage basis for this, 80% of the strategy is mechanical, which means you don't really need to think too much about things, right? It's going to be either yes or no. And 20% is going to be where you actually need to activate your brain and think, because it's not possible to quantify everything, at least for this strategy. And I always find it's a bit of an issue for a lot of traders, because in all honesty, it's quite hard to quantify everything in trading when there's so much room for multiple time frames, different structures, and it gets quite tough. But I've done the work for you, and I can tell you in advance that 80% of what you're going to be learning today is mechanical, and 20% you're going to be having to use your brain. So keep that in mind. Now, next up, we're going to be talking about setting up the trade, which means what is the confluences that we look for? Where does our stop loss go? What are profit areas? Another issue many traders face, right? Because as an example, you may very well know how to enter a trade, but you have no idea how to manage it as you're filled. And that's not something that I'm comfortable with, which is to say that I have decided to make sure that I know exactly what I need to do at any given point during the trade. I don't enter this trade thinking, well, we'll see what it goes, I might manage it this way or that way. No, It's very clear defined rules that are proven to work. And once again, I have the statistics for it. What markets can I use this pattern? Another important question. And in this case, I can only speak about my experience and the markets that I have tested. So we will be discussing a little bit of that as well. Now, going right back to the mechanical development, I have developed a if-then sheet scenario that's going to help you with a lot of your decision making. This is where you go back to that 80% mechanical. So keep that in mind. Recent trade examples, long-term expectancy. I'm going to be showing a Monte Carlo simulation so you can get a better look of how your equity curve could look like if you apply all of these things that I'm going to be giving you today. And lastly, experimentation, because I don't want to force you to do anything in particular. As a matter of fact, it is flexible in terms of the timeframes that you use. And although I don't have the statistics for that because I use the 2 timeframes that we're going to be discussing later, you might find that using 2 different timeframes following the same principles works better for you in particular. So I don't want to cut that road off for you, and we're going to be talking a little bit of that as well. So as I said, this is the last warning. This is going to be an extensive video. If your attention span is not there, then please do yourself a favor, click off and click on a different trading video. Starting off with number 1, definition of the setup. And this right here is directly taken from my plan of action that I follow every single day. Now, let's run through this rather quickly. I only trade 3 D1. D1 stands for daily patterns, okay? But we're only going to be discussing one in today's lesson, which is this one that I've not blurred out. If the video does perform well and you guys want me to, I'm going to be hosting a similar presentation on the other 2 patterns that I trade, because in total I trade 3 patterns, which I trade both ways, which makes it 6. But for today's video, you're just going to be looking at this. Now, when we look at the definition, you might say, oh, bullish and bearish engulfing, that's nothing new. Well, bear with me here, because the way that I've defined this pattern and the way that I trade this pattern makes it quite unique. So let's go through the definition. The pattern that you're going to be learning to trade today is a break below a prior candle low and close above a prior candle high, and the opposite is true for the bearish scenario. Okay, that's, as of now, what you need to know. And let's go through some chart examples. As we said, let's go back quickly over here. The pattern that we're looking for is a break below a prior candle low and close above prior candle high. The opposite is true for a bearish engulfing, because you're going to be able to trade this pattern both ways. So I've highlighted some of them. Now I'm using an indicator to help me illustrate that, but you don't have to, because the definition is easy. It's objective. There's no room for thinking. Either it has happened or it has not happened. So let's go through some of these examples right over here. Here we have one. Once again, very simple. Break below a prior candle low, which would be here, and close above the prior candle high. This is the pattern that you're going to be learning today. Here we have a bearish example. Break below the previous candle high, close below the previous candle low, and so on and so forth. Okay, now as you can see, just based on this chart, which is not statistically significant, the pattern seems to make quite a bit of sense, right? You do get these prolonged uptrends, sometimes for less, sometimes for more, as we can see here, but the pattern is that. And do not worry, because everything is going to be covered in today's lesson, and I've structured this presentation in a way where you have to be patient with the steps to follow. Okay, these are just some simple bullish and bearish examples of the pattern based on the definition that I've given you so far. Let's jump into what is the theory, right? Why is it supposed to work? Well, the reason behind this pattern being efficient is the concept of trap traders and liquidity collection, right? Which is an idea that I've talked about numerous times. Trap traders and liquidity collection. We know that above and below every single high and low in the market, there is liquidity to be collected in the form of buy stops and sell stops in the other scenario, obviously, and obviously stop losses. So that's something that we're going to keep in mind. Now, you're trading with the context of orders needing to drive to a next area. For now, just keep that idea in mind, but you're not going to be thinking too much of it, because as the building blocks appear, everything is going to make a bit more sense. Breaking above and below previous lot mark, closing above below previous lot mark, right? This once again sort of emphasizes the concept of liquidity collection, with a clear example being this one over here, which was a recent trade in Bitcoin, where we had the pattern. Once again, I call it a bearish engulfing. You can call it whatever you like, where we broke above the previous candle high and closed below the previous candle low, signifying that there is a higher chance, and we're going to get into the exact chance in a bit, that this move is going to continue in that same direction. So far, so good. Time frames we use and why. So we only use 2 time frames to trade this pattern. Very, very important. We use the daily chart for the pattern identification, right? The daily is going to suit you as your pattern identification. And we're going to be using the hourly chart for your trade management and entry selection. Now, context assessment and profit taking is going to be covered later, but for now understand that the daily chart, right, and here we have the perspectives, this is the daily pattern that we spoke about. This is how it looks like on the hourly. And this is exactly what you're looking for, right? You're looking for this daily pattern to be translated into the hourly, and that is why we only use the 2 time frames. So you start off by looking at the market on the daily chart. If you see the pattern, then you're allowed to jump on the 1 hour for a potential investigation of the chart, because you do really need to consider the 1 hour and a potential entry point, which in this case would have been here for a short position, obviously, but that's going to be covered in a lot more detail a bit later. Okay, just for now, understand that we need to use 2 time frames and 2 time frames only. Once again, the same picture, but with a little bit of a wider perspective. The pattern appears here. This is how it looks like on the hourly chart, that same pattern. And this is where an entry could have been isolated, but that's going to be material for a bit later, as we said. Now, context, okay? As much as the pattern is very well defined, it is, as we said, objective and mechanical, we still need to consider the context of where the candle is appearing. I would never just trade every time I see the pattern. It is crucial to validate the context. And this is the good part, because actually a lot of contexts are valid. Let me give you some examples, okay? There is a bit of a typo here, but that's not a big issue. This would be a context where I would not be happy with looking for a trade. Why? Because it is in a range. The pattern appears here and here, but the candle is low volume, which we're going to be covering later, okay? But for now, just understand that context influences my decision on whether I take the pattern as a trade or I don't. And there are some contexts that are great to take the trade, and some others where I just simply ignore it, okay? And we're going to be running through them one by one. Starting off with the range, as we said, if the candle happens to be within a range, now it is different if it breaks outside the range and then forms the pattern, but if it happens within a range, then I'm 99% of the time going to be ignoring the signal. Although you can see that in this particular case, this pattern does lead to a nice up move to be that could have been captured. Now, into pools, whether it be highs, lows, swing highs, swing lows, I ignore those. Now, it is different if, once again, and this is the example that I'm referring to, the bearish engulfing appears here. You might wonder, can we look into the 1 hour to take an entry and go short? In this case, I would say no, because we've just reached into a sell side liquidity pool. And that's not something that I'm going to be comfortable trading, because I expect rather the opposite to happen, or at least not to have an easy time moving further to the downside. And as we said, it is different if it does extend well beyond the pool. Okay, at that point, I would consider looking for an entry to go short. But most often than not, if it is into pools, I'm not interested in doing any business there. Low volume bars. As I said, relative to the candles around it, if the candle is not from a volume perspective significant, then I'm ignoring it. Okay, as an example, once again, we have this bullish engulfing that I would have not think it is a good idea to look to trade it, although we can see that it would have eventually led into an up push. But that's not something that I'm gonna be doing. And as you may have noticed by now, I'm not here to lie to you or to bullshit you and tell you, hey, look, yes, I would have definitely taken this trade. You can see how it moved up, and this one I would have ignored. You can see it never worked. No, I'm here to be realistic, and this is a trade that I would have not taken over here because of the condition of it being a low volume bar. We're not interested if the pattern is present as a small candle relative to the ones around it. Once again, more examples over here. This one would have been not valid for me, and this is the comparison of a one that I would, yes, be looking to have taken the trade. As a matter of fact, I took the straight short over here and got a nice winner, although it never reached where I originally would have wanted, which was this liquidity pool. I did get out with a winner in a trailing stop loss, but just to make the comparison a little bit clearer, I have decided to showcase a scenario that I would not consider relevant. This one applies as well, although this one also ended up working. But this is the type of candle that I'm looking for, right? It meets the criteria: break above the previous candle high, close below the previous candle low, and you can see that the candle is volume-wise significant, okay? And here it then happens again, that once again leads to another down push. That is another trade that I took. So yeah. Okay, so now we move on into what a valid context looks like, because now you know what I don't want to see in terms of the pattern, but actually a vast majority of scenarios are valid for me in terms of context, right? We just previously ran through the ones that I don't want to see. Now we're going to be going over to the ones that I do want to see. And as I said, a lot of scenarios do actually make sense for this pattern to be traded on. So the more you trade this pattern, the easier it will be to start determining which ones you need to focus on. And that's actually quite important, right? There will be times where you think a context, let's see over here, is not valid and it works, and vice versa, right? And once again, that's just trading and there's nothing you can do about it. There are times where I look at my daily chart and I can see that the pattern is there. Once again, break below the previous candle low, close above the previous candle high. This is exactly what it looks like on the lower time frames. And I don't take the trade because the context in which this has developed is not ideal for me and is not something that I'm comfortable with. So I would pass on the trade just to see the next day that the market did exactly what it could have done if I was in the trade. But that's just trading, right? There are some times where I think the context is great and I want to take the trade. I take the trade and it fails. And that's just trading, okay? So valid context includes, but are not limited to, pattern at levels, swing high, swing lows, prevalent trends 5 times current daily ATR or more. Now, that might sound like it's a bit confusing, but because I'm a visual learner myself as well, I've prepared some visuals for you. Okay, so these are great contexts where I'd love to see the pattern, and it's not limited to that, but just some examples that are the most frequent ones that I find myself in. So at levels, very simple. We have lows here, we have highs here, we have highs here. The pattern appears, and you can see that it is pressed against this level. This to me is a great context to be looking for a pullback into the short position, following the pattern, obviously, and all the rules that I'm going to be giving you. Another great context would be swings. As you can see, we clear the swing high and the pattern forms exactly then and there. That to me is a no-brainer that I really want to be looking to go short. And as you can see, the next day, a bullish engulfing forms. You can see that it is denoted in yellow. Sadly, I cannot zoom in, but that would be a signal that I would ignore because of the context, right? And obviously it is a low volume bar, as we discussed before, so it is not significant to me. And instead, I would focus on the bearish engulfing, which is denoted in blue, because it appeared at a swing, it is a high volume bar, and the context is just absolutely perfect. Moving on, prevailing trends. Sometimes you do find markets that are more than not pushing higher with minor pullbacks. That is also a great scenario to be looking for a long position in this case, because it's an uptrend, and the opposite would be true for a bearish trend, looking for a bearish position if the pattern emerges. Because actually what this pattern denotes, as we said, is a grab of liquidity, and when a grab of liquidity has been completed, as an example, this low here, then our objective could be to move into a next level. So it would make sense that in trends, it's actually a good idea. Now, how do I measure this? Because this is also objectively defined. So I use the ATR indicator, which you can find for absolutely free on TradingView. I set it to a 20 period. That's the only setting that I change. And if you do that, you will get a number, right? You will get a number over here every day that changes. Now, what I do is measure that number times 5. Is it bigger than the current trend, right? If it is, then yes. If the pattern emerges, then I can trade it because the trend is significant enough. And do not worry, it may sound confusing for now, but everything is going to be a lot clearer. Now, let's summarize. What do you know so far? It's important that I don't lose any of you, because as I said, I understand that this presentation is quite hefty in terms of the content that it includes, so I want to make sure that everyone is following. And do not hesitate to rewatch certain sections if you do need to do so. So, what do you know so far? Now, as of now, and please tell me yes, you should be able to understand how the pattern looks like, right? We've spoken about this numerous times by now. The pattern is simple. Let me actually do this properly. Okay, that would be the pattern right here. A break below a previous candle low, close above the previous candle high for a bullish example, and the complete opposite would be true for a bearish example. Okay, that's the only thing you need to understand in terms of the anatomy of the pattern and how the pattern is supposed to look like. Now, you should also by now understand why the pattern makes sense from a theory-based pattern perspective, which is what we spoke about in section 2 of liquidity being collected and traders being trapped. You should also know that we use 2 time frames and 2 time frames only, the daily for the pattern identification and context, and the hourly for entry selection and trade management, which is what we're going to be moving on. I think it's right after this slide, but I'm not sure. Now, you now know that the context in which the pattern appears is important and needs to be evaluated before proceeding. That's also something very important that you do know as of now. Setting up the trade. In this section, we're just simply going to be talking about where your entry should be exactly, why it should be there, what are confluence factors that we look for, where does my stop loss go, how do I manage the risk, and all the rest of it, okay? This is going to be quite a lefty one, and you need to make sure that you're paying close attention. We're going to be focusing on the 1 hour because that's the time frame that we use for that purpose. The daily is only for context and pattern identification. So this part is very easy mechanical, okay? You're gonna see that because I've done the effort of actually making sure it is easy. So 1 hour time frame, what do I look for? Now, due to the anatomy of the pattern, and let me highlight this for you, the only thing you need to look for is for a pullback into a naked wick to take an entry. Okay, naked wick is exactly what it sounds like. It is a wick that has not been yet mitigated. Now, I have numerous videos on the naked wick concept, and if you are not sure by now, you can, after watching this video, go back to a naked wick video and then come back to this, and you're going to be a lot better off. Now, ideally, and keep in mind that I'm writing ideally, it is not a conditional. You want to line your entry point with a fib level. And for me, and based on my statistics, 90% of the times where I take this trade, it does end up lining up with a fib level that I've determined in advance. But remember that I'm saying ideally. Sometimes fib level does not play a role. The more amount of wicks that are present at your entry point, the better, okay? And for those of you that are visual learners, we're going to be going through some examples. Your stop loss will always be protected with a thrust candle. Once again, the thrust candle principle is another idea that we've spoken about numerous times. Let's say there is this level here. The thrust candle would be anywhere from here to here. And more specifically, it is the candle that closes above the level, so above this line. Sorry, that opens above the level, above this red line, and closes beyond the level. Okay? But don't worry, I'm here to help you with that. So this is exactly the scenario that we look for. Okay? So let's make sure that everyone is following. This section of the market right here, this move down, is your daily bearish engulfing that we spoke about, right? This is exactly how it would look like as you zoom into the 1 hour chart. The daily bearish engulfing. Why? Because we see it over here. Break above the previous candle high, close below the previous candle low, which I cannot clearly see because I'm not on the daily chart, but I would assume it would be any of these lows here, depending on where the previous daily candle actually closed, which I cannot see as of now. But the pattern is this section over here. Okay, this move down represents and creates the daily bearish engulfing. Okay, now we've identified the pattern, we're happy with the context, now we're zoomed into the 1 hour to trade it. What do we do? The first thing that you're gonna do is fib. Add a fib tool from the pattern high to the pattern low. Once again, in this case, the daily bearish engulfing high to the daily bearish engulfing low, or pullback low, because sometimes it will extend on the next candle, and this could have happened, and I would have still been looking for the trade. I would have just need to adjust my fib to, in that case, this low, although this lot mark would have never changed. Okay, now we've identified the fib, and you can see clearly visible on screen now the levels that I pay attention to, which are the 38, the 50, the 61, and very rarely the 78. As a matter of fact, I don't think I've ever used this one, but it's just there. Okay, because if the market happens to pull back that deep, then you really need to ask yourself, is it really gonna go down from here? Or maybe it's just gonna go for the high, right? So the 78 actually you can quite ignore because I haven't really used it. It's mainly the 38, the 50, and the 61, okay? So we've added the fib, we know the levels we want. What do we look for? We look for a naked wick, that's all, okay? Naked wicks are here, another one is here, another one is here, and this one, I don't know if it's actually tested. So this one is not valid because you can see that we did reach there. So that's not something that we're going to be concerning ourselves with. So there you have it. Those would be your entry points. As we said, we need to make sure that they line up with a fib level. It is not a conditional, but it is better if you get the chance to. Now, you can see that there is a clear level that we've broken below, which is also something that I want to see, right? We have multiple lows and we have a level here, an obvious one. A level would be here as well, okay? But that's just to showcase what a level looks like. It's not really relevant in this example. Now, once we've done that, we need to determine which of the naked wicks are going to be your entry, and obviously your stop loss and take profit. What I would say in this scenario, and to help you make better decisions, is your job is to get into the trade, okay? In my opinion, if you look at this chart and said that your entry would be here, I would say that's a mistake, because as I said, your job is to enter the trade at a optimal level, and you need to balance the probability of getting filled, because we work with limit orders, to the probability of the payoff, right? If you're only focused on getting the best risk to reward, you're gonna be missing a lot of trades. But if you're working on striking a balance between getting into the trade and having a decent risk to reward, then that's actually the sweet spot that you're gonna be wanna be going for. Now, where do we place our stop loss? As we said, we use the thrust candle, and looking at this down move, the thrust candle should be easy to see, because this is the level that breaks right over here, and now you ask yourself, which one of these candles is the one that that opened above the level and closed beyond it? And the only correct answer is this candle right here. Why? Because it is the candle that opened above the level and closed beyond it. So your stop loss in this trade would be here. Now, you might say, what a weird place to place your stop loss, right? Actually, it is the best place to place your stop loss. Placing your stop loss here is bad. It's actually a mistake. Why is it a mistake? We do know about the fact that above and below every swing, there's going to be liquidity. So do you really want to place your stop loss there? Not to mention it kills your risk reward ratio at the same time. The concept of placing your stop loss beyond thrust candles is actually the best one. Why? Because you're protecting your stop loss with the fact that if you are going to get stopped out, the market needs to close beyond this level. Okay, this set of lows here, which you're not expecting to happen anyways, because you have your daily bias to, well, tell you that shorts are in play. We've just trapped liquidity above highs. We've seen a clear displacement lower. We should continue going lower. Now, is that always right? No, it's not. Absolutely not. Is it right more often than not? Yes, absolutely yes. So that's all that you need to know, guys. It's very simple. You're placing your stop loss above the thrust because it is a candle that opened above the level and closed below it. And if you're going to get stopped out, the market has to work very hard to get above the level and stop you out, which will happen. Guaranteed will happen, but more often than not, it's just going to reject the level and move lower. And that's all you need to know, boys. That's all you need to know. Now, that was an example of a bearish entry into the trade, and this is the example of a bullish entry into a trade. Same principles, right? This is very mechanical. Once you identify the pattern, you place the fib level from the pattern low to the pattern high. You look for a level. Otherwise, you don't like the context of the candle, and you can see we have a clear level here of highs. You can see that we've broken out of it, and you are essentially waiting for a pullback. All it is to enter this trade is a pullback into a naked level, as we said, I think it was 4 slides ago. So same principles. Where would be the optimal play? Where would be the optimal place to enter your trade? In my opinion, it would be right over here. And by the way, these are all trades that I've taken, okay? And I have them in my journal, which I think I've showed in the previous video. So that would be the optimal area to enter the trade. We have a naked wick on the left-hand side. We have a fib level lining up. And we have a thrust candle right over here. Same principle. That is the candle that opened below the level and closed beyond it, fractionally higher, but it did close beyond it. Now, would I have said that trying to enter the trade here is a mistake? I would have said so. Why? Because your stop loss would be here. And if you're expecting the market to get that deep, then you should also be expected to get stopped out, because I never work with tight stop losses. And the reason why is simple. It's actually math. If your stop loss is really close to your entry point, then you're going to get stopped out a lot of the times. That's just how it is. I don't care if you come at me and say, look, I have a 80% win rate with a 1-to-7 risk to reward ratio. I am very precise and I never miss. I don't care. Okay, I've been here long enough. I know what makes sense and what doesn't. And to me, what makes sense is striking a balance between a decent risk reward ratio and a decent stop loss size, so I don't get stopped out every time. Now, the same principle applies, right? This is, once again, this move up here is a daily bullish engulfing with the definition that I've given you, okay? Very simple. We break below the previous candle low, we close above the previous candle high, which once again, we cannot see, but let's imagine it's here. And that's simple. Once that has happened, you're going to jump into the 1 hour time frame and you're going to wait for a pullback. A pullback to where? A pullback to a naked level and a naked level only. Now, there's going to be multiple naked levels and you need to make a decision. As I said, work to strike a balance between a decent risk to reward and getting into the trade. Because if you tell yourself, well, I'm going to be waiting here because if I get here, I can place my stop loss here and then I'm going to have a huge risk reward. Then what I would say to you is good luck getting into trades and good luck watching every trade go without you just because you're being a prick for a tick essentially. Okay? So keep that in mind. Another example of a level, once again, the level is visible here, although it is not as clean as the other example. And this is a trade, by the way, that I took recently that failed. Okay? I lost this trade and nothing has changed from this slide to the previous one. It is the same concept. This move down here is the daily bearish engulfing forming. The candle closes, the daily candle closes somewhere over here. So I look at the chart and tell myself, great, the context is great. Let me look for a pullback to take a trade. Where did I enter the trade? I entered the trade right here. Where was my stop loss? Above this candle. Where did I target? Well, we're going to be saving that for a little bit later because you might think it's here. Well, you might actually be surprised, okay? In some cases it might be, but it's not always the case. So yeah, as I said, this is a losing trade that I took and it's the same concept. But you can see that the market had to work very hard to stop me out. I entered the trade here, I went into drawdown, then I need a bit of profit, then into drawdown again, then back to profit, and then eventually, actually I think this didn't stop me out. I was still in the trade at that point because remember that my stop loss was sitting a few pips over this candle high. And eventually I did get stopped out over here. Okay, so keep that in mind, that even though the scenario looks the same, you're still going to be sometimes losing a trade. So the missing pieces, okay, you now know a lot of things about the pattern, but you're still missing some information that's going to help you make it a little bit more mechanical. But let's summarize a bit of everything once again. You should now understand how to enter the trade, okay? We've went over it in a lot of depth. You should now understand where to place your stop loss. You should now understand the confluence factors that we look for, which is only the fact that you need to enter at a naked level. With preferably a fib level from pattern high to pattern low lining up. Excuse me for that. You should also, let's see over here, what will we focus on now is understanding how to manage your position if you get filled, which doesn't always happen. As a matter of fact, I currently have 3 active orders that have yet to be filled. When to cancel an order and where to take profit, because that's what you're missing in terms of trading the pattern. So let's kick things off with profit taking. Where do I take profit? You can see, okay, and this is a bit of a spoiler, but there are different options. I think there's a total of 3, and we're going to be running through each and every single one of options to take your profit one by one. Starting off, once again, this is the pattern that appeared, and I traded this trade in particular because I like the context. Why did I like the context? Because it cleared a swing high and closed below it. So the context was awesome. So I had to ask myself, where do I think this is going? Now, I would have said that there are two options. In this case, if we're only focusing on structure, then your take profit should be here, which is this candle wick high. And you might say, well, that's not really that much room, is it? Well, because you would enter, obviously, somewhere in the pullback of this green candle. The reality of it is that actually there is a lot of room to make money here, because you have to remember that this is a daily chart and you're entering on an hourly chart with an hourly base stop loss. So this is actually a potential for a huge winner, even if you're aiming for a conservative move of reaching into this naked wick high here. Okay, so keep that in mind. Now you can see with hindsight that, oh yeah, you should have held all the way to this naked wick here. But the reality of it is, if you aim for these huge winners, which would be a huge winner, you're gonna lose the vast majority of the trades, and that's not something that I want to do personally. Now, if you do find that you can get away with aiming for these huge home runs and losing 80% of the trades, then that's on you. But that's not something that I'm comfortable with. As I said, I'm looking to strike a balance. And if you're looking to target opposing structure on the daily, by the way, not the hourly, then your target should have been here. And that's about it. Arguably here, if you're not too comfortable with the trade. But please understand that there is more than enough room in this move from this candle to this candle to make a lot of money. Okay, that should never be the concern when you're looking at a strategy like this. At liquidity pools daily, and I'm actually quite confused with this chart for now because I haven't really looked at it in the past few days. And okay, I see now. So yeah, as an example, this would be your entry point. Well, not your entry point, sorry, this would be your pattern identification. And if you do like the context, which I'm not suggesting you do in this scenario, once again, I'm just trying to show you where to target. You could target a opposing liquidity pool, which any swing high or actual high is. Okay, and the pullback origin from the 1 hour, which is the GJ example that I showed before, where I actually lost the trade, where I was targeting here, this low here, which is the pullback origin. As we said, we enter on a pullback into a naked wick, and you can always target the pullback low in this case. Okay, I entered here, my stop loss was here, and my target would have been here. And you can see, and although we cannot measure this, the risk to reward would have been great, right? This would be close to 2 risk reward, 1 to 2. Okay, that's something that you can target as well. So I've given you the 3 scenarios, okay? And I'm not going to repeat them, but let me show you once again what they are. Opposing structure, liquidity pools, and pullback origins. Those are the 3 things that you can target when looking to trade this strategy. Okay, so let's carry on. Managing your position. Okay, so now we've talked about a lot of things, and now you've reached the point where you're in the trade. So what do you do? The way I manage my position is simple. I denote areas of trouble that stand in between my entry points, so where I'm filled, and my target, so where I want to get out. Every time a candle closes beyond one of these areas of trouble, I move my stop loss to that candle high or low, depending on if we're going long or short, obviously. If it happens to pull back with space, I will re-add the risk that I have saved with my stop loss movement. This is actually very important to getting huge winners, because getting big winners is not only about having great risk to reward ratios, it is also about having the confidence to add to their trades. And this is something that I had to learn the hard way, because guys, let me tell you, good traders and profitable traders add to winners and cut their losses short. Okay, not the other way around. What I do see a lot of amateur traders do is adding to losing trades, getting their losses getting bigger and bigger, and cutting their winners short because they're so afraid of giving the money back. And being afraid of giving your money back is an uncomfortable feeling, and I know it firsthand, but it's something that you need to get used to. I want you to change and switch that mindset of being afraid to adding to trades, but never being afraid of adding to it if it's in a loss, just because you can say to yourself, oh, I get a better average entry. No, that's not what you want to do. You actually want to do quite literally the opposite. So let's run through this. That way I never go above the risk I had originally planned, but have the option of making a lot of money if it does reach the take profit. As I said, guys, and this is quite simple, let's say, let me print an example here rather quickly. Okay, so we get the pattern, okay? And the pattern will always look something like this on the 1 hour. And I wait for the pullback into a naked wick, and I take an entry here with my stop here. And I'm looking to target the pullback origin in this case. Well, there's going to be levels that stand in between my entry and my original target. So every time the market closes beyond one of these levels, I trail my stop loss, and the risk that I've saved, I re-add on the level from the other side of it. So I expect a pullback to enter another position, and the same happens here, expecting to reach the ultimate take profit. Okay, and I know it's confusing now, but you're gonna see how this makes a lot of sense. So managing your position, this is another trade that I took recently on the USD CAD. I believe it was on a day where we had CPI, because I remember this push down very precisely. So I looked at this and I liked the context of this candle. Why? Because it had closed above all these highs. So pull back into this area, potential opportunity to go long, right? You can see the pattern never changes. The pattern is objectively defined, and the pattern is there present, which is denoted in yellow. This is how it looks on the 1 hour time frame. Okay, so the day the bullish engulfing happens is where we get this move up here, and somewhere here is where the day ends, and I'm jumping into the 1 hour, looking and asking myself, where do I need to place my limit order to go long? So what I did is simple. I looked for a naked wick. I went with this one. It is naked, although it doesn't seem like it here. There is 2 pips difference between this candle high and this candle low. So it is technically naked. So I place my limit order here. I place my stop loss beyond the thrust, and I targeted the pullback high here. Now you can see that as I enter the trade here, I am in drawdown, okay? But once again, my stop loss is here for a reason. I did not expect to mitigate that deep. This is one of the rare scenarios where putting your entry here would have been a lot better in terms of risk-reward ratios. But as I said, I'm never concerned about that. You can see that the 78 did line up as well there. So, but the 61 did line up here as well. So I was happy with that. So I entered the trade there. I placed my stop loss. And now, as soon as I'm in the trade, I'm mapping out the areas where I know that the market could have trouble at. And one of those areas is obviously here. We have lows, lows, highs. Now, as the market moves, whether it's in my favor or not, new areas of trouble can develop. As an example, as we move up here and pull back, this becomes an area of trouble getting up off this high. So what I did do for this trade, and I need to try to remember this because this was, I believe, 3 weeks ago, and every scenario is different, is as soon as this candle closed beyond this high, I added risk back, okay, and I moved my stop loss below this candle. My stop loss was always here until this candle closed. The moment that candle closed, the risk that I had saved from moving my stop loss to this low, I tried to re-add it here at this high. So it pulled back, right? Sorry, it broke out. There's still space. We pull back with space to the area of trouble. I add my risk back here. And the same thing happened over here and eventually got stopped out here with a lot of profit, as you can tell, because all my stop losses were here and I had added to this trade 3 times. So you can imagine that even though the movement is not that significant, what I got is from from here to here, right? This is what I profited. Even though it's not a big movement, it's a decent sum because of the way that I manage my trades. And all you need to remember is that you need to determine the areas of trouble that stand in between your entry point, which in my case was here, and your take profit, which in my case was here. And you also need to remember that new areas of trouble do develop as the trade progresses. Hopefully that made sense for you, okay? And this is actually how it looks like in terms of where I had my entry, my stop loss. You can see that I went into drawdown. It eventually mitigated deeper into this area, eventually started moving in my favor, and I got stopped out over here before the trade reverses and eventually goes back up and then goes back down and up and down, and eventually would have hit my stop loss, but I was already out, long gone out of this trade with my stop loss over here, if I'm not mistaking that. So you've learned quite a bit of things now, but we have to keep moving on to canceling orders, because there are times where I do have to cancel my limit orders. If price comes within 10% of ATR to my order and runs 60% distance to target without being triggered into the trade, I will cancel my order. Now, it sounds confusing, and you can see that it is important for me to have objectively defined as much as I can. Okay, let me show you an example of a recent order that I had. Now, mind you, this is not a daily bearish engulfing pattern. This is another daily pattern that I trade, which has more to do with a gap close. But in terms of canceling orders, the same principle applies, right? As the market was over here, I was looking to go short here with my stop beyond this thrust candle here. Because of the market moving close enough, once again, 10% of current daily ATR. What is current daily ATR? Daily ATR is 30. What is 10% of that? That is 3, if I'm not mistaken. So if the market comes 3 pips to my entry and has a reaction of over 60% to target, which would be somewhere over here, can't really measure this, then I'm canceling my order. Now, if it does reach the ultimate take profit, and I'm not filled, I will cancel anyway. So in this case, the 10% ATR rule didn't matter. Because why? Because the market went to take profit anyways without me being in the trade. Okay, that's just something that you need to remember, that I do cancel quite a lot of orders, because it's not like I always get filled, but I try my best to getting filled, okay? So let's jump now into the statistics of the pattern, and please ignore this. This is actually not the statistics of the pattern. These are just statistics in general, which I thought looked good to start jumping into this section. Once again, what you see over here is the work that I did. And this is when I started the process of working on these patterns that I, by the way, did not invent it, and I'm going to be giving credit where credit is due, and at the end of the presentation you're going to see that. But just for now, remember that this is not something that I came up with. This is something that Tom Dante, as far as I know, taught, and I just took bits and pieces and collected data on it to help me make better decisions. So as I said, this is when I was in the building stages of trying to get more mechanical in terms of my trading. And you can see that this is the document that I wrote in particular to help with that. As you can see, my goal was to get about 80% mechanical decisions and 20% discretionary. The good thing is the idea, quantification, and execution of the strategy is clear. Now I just need to focus on answering a few key questions, I think, and I think I need to take them one by one. So this is what I wanted to answer when I started collecting statistics. What data do I need to for each pattern, right? Because I was testing 3 different patterns on the daily. Remember the original slide of A, B, and C. I'm only running you today through A. But if this video gets a lot of support, then I might consider doing the same for B and C, because these are the patterns that I trade. How will that data be presented and collected? What are the definitions for the patterns? How many patterns? Do I consider the context, or is it just the patterns that matter? Determining the data time period in markets, if then sheet, which I'm going to be giving you later. Okay, so this was the original work. And this is a little bit more in depth. This is what I wanted to find out, and the statistics that I wanted to collect. Now, I'm only going to be showing you today, and partly because this is my work and it's my decision, the probabilities of a bullish engulfing achieving one time its own pattern range, which is very simple to understand, and in reality is all you need to know to really see if the pattern is profitable or not. So what I wanted to answer with this is simple. What is the probability of a bullish engulfing, if it appears on a daily, achieving one times its pattern range? So if the daily bullish engulfing emerges and it looks like this, and we measure this candle and it turns out it's 120 pips, right? Let's say this is 120 pips. What I wanted to know is what is the probability of achieving this 120 pips in the same direction of the bullish engulfing once it has formed. So this candle closes. What is the probability that it's now going to move 120 pips to the upside before taking out this low? And that is the probability that I wanted to answer alongside a few others that you can see over here. And these are the statistics. And mind you, this is the statistic without taking into consideration the context, okay? So this is not your win rate. This is not determining how many times you're going to win. No, this is just the probability of a bullish engulfing achieving one time its own range without considering the context. So if you do factor in the context, which I have not done because this is profitable as it is, then it's probably going to be a bit higher in terms of percentage-wise. So there is a 57.25% that a bullish engulfing is going to repeat its own range before taking out its own low. And the opposite is true for a bearish engulfing. And that's all you need to know, because this is telling you that every time you see the bullish engulfing on the daily, probability dictates that it's going to carry on in that same direction 57.25% of the time, and it's going to do that at least one time its own range for 57.25% of the time. All right, so hopefully that made sense. I'm not going to jump into more statistics because you don't really need them. This is all you need to know to ensure yourself that the pattern works. And once again, you don't have to take my word for it. You can freely do the work yourself and backtest the data. I have 7 years of data, and this is the result. So let's carry on over here to section number 7. In what markets can I use this? And let's be realistic here. The reality is that I can only answer that question for the markets that I have data on, right? I'm not going to here and tell you that it works in stocks or it works in whatever market, because the only markets that I have experience with are these ones over here, mainly forex majors and some minors, not exotic, because sometimes, actually, very frequently, I will hold trades during the rollover. And if I'm trading exotics, then the spread is going to jump to God knows how big, and that's going to be difficult for my position. So I've made sure that I only add markets that I know that when the rollover comes, I'm not going to get stopped out because of spread. Very important now. Obviously, the broker you use also plays a role in that, so you might want to explore what broker works best for you, but that's something to keep in mind. Now, the discrepancy in performance between markets in the long term is close to zero, which is to say that, as an example, the euro dollar is not statistically significantly a lot better than the USD yen. As a matter of fact, they're quite similar, and that is across all assets that I trade. So you should not be worried about that. Although it wouldn't hurt to sort of gather some statistics on that for your trading as you trade. I'm actively trading this pattern on the following markets, obviously CFD products, forex miners and miners, metals, indices, and crypto. In specific, these are the ones that I trade on, and I denote in red the ones that I'm actively looking for something, okay? But you can see that forex is here, metals are here, indices are here, and crypto is here, which is only Bitcoin, the spot chart. So keep in mind that these are the markets where I trade this pattern on. Now, I want to jump a little bit into a different topic, which is mechanical development. And I've just shown you some previous sheets that should help you with that, but I want to run through this once again rather quickly. Quantifying and defining concepts is very hard to do in trading. That is why there are very few traders with successful algorithms, right? And this is just a truth that I want to get out there. Being able to quantify everything you do in trading is extremely difficult. As a matter of fact, I wasn't able to do that, but I did achieve about an 80% mechanical, which is great because I don't spend too long to look at a market in order to determine whether there's something for me to do. I just have to look at it for 5 minutes. Is the daily bullish engulfing or bearish engulfing there? If it is, great. Then I will have to spend a bit more time investigating the 1 hour to see if there is a trade for me or not. Because sometimes the pattern is there, the context is there, but the 1 hour doesn't match what I want to see. Either there's no naked wick, or we haven't really broken out of any level, or whatever it may be, right? Those are essentially the two reasons why I would pass on a daily or bearish daily bullish or bearish engulfing, even if the context is great. It happens very rarely, but it does happen. So this strategy is about 80% mechanical, which is a great success in my opinion. However, the human element is still there, and you need to remember this. If you trade this pattern and you try to get a trade every day, unless you're looking at 50 markets, I can guarantee you that you're not going to get a trade every day if you're being picky with the context. Because yes, the pattern can appear every day, everywhere, but you need to consider the context. And as I said, there's a lot of contexts that are valid, but some of them are not. In order to help me with my daily process of trading the strategy, I have developed a if-then conditional sheet. This is extremely useful. It helps you with making sure that the trades you take are following a strict process. And this is the if-then sheet that I developed. Once again, inspiration from Trader Dante. This determines everything that I do as I see the pattern. So let's run through this. I don't think I need to go through everything, but let's go through the main points. So I start off my day, I open my chart. If I see a daily engulfing pattern, then I will consider the context and location. If the context of the pattern is compelling, then I will drop into the 1 hour, right? For the vast majority of daily candles with the pattern that I see, well, I wouldn't say the vast majority. For some of them, the process ends here because sometimes the context is just not compelling and I have to pass on it. So for the times that the context is compelling, then we can run through this document. If there are naked levels of structure beyond market, then I will check for the D1 fib, as we said, from pattern low to pattern high. If there, then I will check daily fib confluence and the naked wick here. This is another word for the naked wick. If there is a level meeting these criteria, then I will look for a suitable stop. So if there is a level that meets these criteria, which is to say, okay, this is the area where I want to place my limit order, then I will look for suitable stops, which would be a thrust candle, and so on and so forth, right? I mean, I don't think I need to run through this sheet in particular. You can read it out for yourself, but this is just essentially trying to make my trading a lot more mechanical and focusing on the process with if-then conditionals that are going to help you guide your decisions. Recent trade examples. Once again, we have the USD CAD trade that we spoke about before. I haven't really added the pound yen, which is a loss, should be up here. The gold trade that I took is here. This was actually a loser. This was a gold trade that I took. You can see that there are all the patterns here, but the vast majority of the time I'm trading the engulfing pattern, as you can see from my journal, and I do lose trades. Here we have a 2 times where we lost, but we also get winners, and the winners in general are a lot bigger than my losses. This is a trade example. This is actually the gold trade example that I spoke about earlier, where we have the daily bearish engulfing here. The context is compelling because we close beyond these lows and we pull back to it with space. The candle is quite big. We have H1 level here being visible. We have a nice naked wick here, which is this yellow line with a fib level. So I entered short right here. You can see the execution. My stop loss was at this yellow line. We had 50% fib. And I was targeting here, the pullback origin low in this case. And you can see that I got stopped out because, as you see, I determined the areas that stand in between my entry point, which is let me use red in this scenario, my entry point, which is here, and my original target is here, and I'm marking out the levels where I think the market could have trouble at. And you can see in hindsight that it did have a lot of trouble there. So in this case, the market reached into this level, wasn't able to break below it, and moved all the way up. But I got stopped out right there. I don't know if you see the arrow, but that is exactly where I got stopped out, because I moved my stop loss the moment we closed below this level. And it's a shame that I cannot zoom in, but the moment we closed below this below that level with this big red candle is where I trailed my stop loss above it, and I got stopped out. I took a small profit, but it was a decent enough profit, and it was a winning trade at the end of the day. And it was, more importantly, following the process, right? The pattern appears, you jump into the 1 hour, you flip from pattern high to pattern low, you look for an area to isolate an entry, you try to make sure it's with a fib level, and you determine the areas that stand in between your entry point and your take profit, and you look to mitigate your risk, moving your stop loss. Remember that my stop loss was originally over here. So yeah, we can see it a little bit better here. Okay, but I've just gone through this in a lot of detail. I don't think I need to make sure that that is spoken and said again. You can see that this is actually taken from my journal. You need to make sure that you're journaling your trade. So original stop loss here, entry there, got stopped out right here with this big green candle, which was actually a news release, so that was unlucky. And yeah, eventually it would have gone lower. It would have never reached the ultimate take profit, but I would have been able to mitigate my stop loss above this big green bearish candle, which wouldn't have made too much of a difference. As you can see, it would have been stopped out pretty much in the same area. Okay, so this is the long-term expectancy. This is 550 trades in advance, and you can see that depending on your luck, yes, because luck plays a role in trading as much as you want to deny it, your equity curve could look insanely good or a little bit more flattened out, but overall, all of them should be in profit if you trade for 500 trades, 550. Actually, it's 500 right over here. So although luck matters, if you trade well, you should be in profit no matter what. Okay, now, as we said, if you're extremely lucky, then you're going to have an equity curve that looks like this pink one over here. But that is essentially the best case scenario, which is not the usual scenario. The usual scenario is this thick black line that you see over here in the middle, which would be the typical scenario after 500 trades. Okay? Now, experimentation. You can experiment as much as you want with the bullish and bearish engulfing concept and the basis of trading that I've given you. As I said, you can try to see if maybe using the 1 hour as your pattern identification instead of the daily, and using the 1 minute to do what the 1 hour does in my explanation, then you can get maybe more trades and similar results. I haven't really tested it, but that's just something that I want to pass on to you, right? You don't have to do exactly what I do. I'm just sharing what I do. And if you do find that the daily is a bit of it's a bit too long term for you, then maybe you can say to yourself, okay, so I'm going to be applying the same logic IPDATrader has taught me, but I'm going to be doing that in a different time frame. So what I'm going to do is my daily, the daily that IPDATrader spoke about is going to be my 1 hour, and the hourly work is going to do the 1 minute work in this case, because I want to use the hourly and the 1 minute, right? That's not for me to say. It's just an idea on how you can experiment with this pattern. You can try different methods of managing your risk. You can try different contexts as to what contexts are valid for you. But if you want positive results, the approach that I've given you is a solid option, right? Because it had been tested, I've done the work, and that's about it. So congratulations, you made it. Now, you are officially better prepared than 90% of traders who were unable to make it through the video. As I said, I wanted to give credit where credit is due, mainly Tom Dante, but Sam from KB Trading was also a huge inspiration for this, okay? You can check both of their socials out, but I believe Tom Dante is the originator of all of these concepts. None of this is financial advice. I'm just sharing my own perspective. So if you enjoyed the video, and I know it's quite lengthy, then you can drop a like and, show me some gratitude for doing this. This is absolutely for free on YouTube, and I'll see you in the next one.